My name is Craig Lazara. I'm a Senior Director in Product Management at S&P Indices. I'm here today with Rick Ferri, a registered investment advisor based in Troy, Michigan. Rick has many accomplishments to his credit. Most recently is the authorship of a new book called The Power of Passive Investing. And this afternoon we're going to use that book as a way of kind of generating a discussion about what passive investing is and why it can be useful to financial advisors and individual investors. Rick, let me start by just quoting you, which must be a useful thing. That's a new one. It must be a useful thing. But I was particularly struck by the way you began the preface of the book when you said, did you ever buy something because you thought it was a superior product only to be disappointed with the results? That's the problem with most mutual funds. Why don't you elaborate on that? That's a great way to get into that.
I think that investors and advisors are buying actively managed mutual funds, hoping that this is the one that's going to outperform the indexes. The problem is that most don't, and the ones that do don't outperform by very much, and then they don't outperform for very long, so they become a big disappointment.
Some of our listeners may not be fully conversant with passive investing, and the title of the book, The Power of Passive Investing. Give a brief explanation of what that is for those who were not familiar with it.
I think the best explanation is not to try to predict what markets are going to do, and to just take positions in the market, set allocations for a very long term. And I think the best way of doing this is using index funds and exchange traded funds. So you're not predicting, you're not doing market timing or sector rotation. You're doing a set asset allocation based on your needs, and you're rebalancing every year back to that asset allocation using index funds and ETFs. That, to me, is what I'm trying to get across as a passive portfolio.
So when you refer to passive investing, you mean both passive in terms of security selection as well as asset allocation?
That's correct. Some people say that rebalancing is an active strategy, and I don't want to debate the minutia of it all. But
it might be.
But it's not predicting. All you're doing is get everything back to what your needs are, what your asset allocation should be based on your situation, and I don't consider that active management.
Yeah, I understand. You've taken the view, and obviously your book is about this, and other work you've done also goes to the same point, that active investing strategies that try to beat the market typically fail to do so, at least for the majority of investors who engage in them.
Yes.
Give us a little background on why you think that is. Why is it so difficult for the average investor to outperform by selecting an actively managed fund?
Well, why I think that is because I went all the way back to the 1930s and looked at every single academic study done on active versus passive. Mm-hmm. And it's not me, it's just counting heads. Mm-hmm. And when you start counting heads, you realize that the ones that survive, because a lot of these active managers, it's a rotation. They come out, they might shoot like a rising star, shooting star, and then they fizzle out. So you have an awful lot of turnover of active managers. But even the ones who survive, only about 1/3 actually outperform, and they don't outperform by very much compared to the ones that underperform. And I'm talking about all indexes too. I'm not just talking about U.S. equity market.
No, that's an interesting comment, because oftentimes I've heard it said that in things like the U.S. equity market, say that the stocks in the S&P 500, obviously a big cap index concentrated in the U.S. For that segment of the market, indexation may be okay, but for less efficient parts of the market, say small cap U.S. stocks or international stocks or emerging markets, that's where active management can add value. Is that valid in the data?
No, it's not valid at all. I mean, it doesn't matter what asset class you look at. The active managers who survive, only about 1/3 outperform, and they don't outperform by very much or not for very long. So it really doesn't matter what asset class you're looking at. I think the biggest problem is not using the right benchmarks for these active managers. And then it looks or it appears that they might be outperforming when they're really not. So you have to have the right benchmark.
A good point. Do you find, or do the data show that some market environments are more conducive to active management than others? I mean, again, people have said, well, in bull markets you should index, or in bear markets you shouldn't, or vice versa.
Well, the bull bear, it doesn't make any difference if you look at the data. I mean, in bull markets, indexing 1/3 of active managers outperform indexes. In bear markets, 1/3 of active managers outperform indexes. These are the survivors. So that doesn't matter. I didn't find any area of the market where if you didn't do some type of index fund, that you would have done poorly. You would have done well. You would have never been on top. But over time, you float to the top. Over a 10, 15, 20-year period of time, there's a 99% probability your portfolio will outperform all portfolios of actively managed funds.
Mm-hmm. You had mentioned in the book in a couple places that S&P's SPIVA reports and persistence scorecards. Can you comment on how investors or advisors might use those as guides to the data?
Sure. S&P puts out 2 reports on a semi-annual basis. The SPIVA report simply looks at active managers' performance relative to S&P benchmarks and compares how well the active managers are doing. It's a pretty straight comparison. And generally 1/3 outperform and 2/3 underperform if you want to look at the big picture of the surviving ones. They also show you how many don't survive. Mm-hmm. You also get the survivorship information in the persistence report, because here we look at the managers who did well, the top quartile versus second, third, or fourth, and we see how they did in the next period. So if you had 3 years where managers outperformed, how did they do over the next 3 years or the next 5 years? And it's almost completely random. It's a random event. Right. Past performance is not an indication of future results.
Yeah, that's the sense in which I suppose, coming back to the statement in your preface, that you may buy a fund because it's done well, but and of course the natural assumption that many investors make is that past performance does predict future performance, and what you're saying is that both the data and the theory say that isn't true.
It is actually, there is some theory data that is true, and that is that the worst performing funds tend to be the ones that go out of business. Mm-hmm. And that is fairly persistent. About 50% of the funds in the bottom quartiles are not around 5 years from now. So what happens is they might be in the top, they fall down to the bottom, and then they go away. And there's this rotation of active funds that take place.
And you come back to the 1/3, 2/3.
1/3, 2/3.
Yeah, well, considering that I can do 50% by flipping a coin, that's a daunting set of odds.
Well, the other problem is that the outperformance isn't by very much compared to the underperformance.
Right.
If you're going to go to the next iteration and you're going to say, well, 1/3 outperform, 2/3 underperform. If the outperformers outperform by a lot, then it's still
make a
good bet.
Maybe a fair bet.
Maybe a fair bet. The problem is they only outperform by about 1/3 of what they need to outperform by to make it a fair bet. So there's not that many that outperform, and the ones that do don't outperform by very much. So it's not a fair game.
Exactly. One of the things that I thought was particularly interesting in the book was a discussion you had on the benefits or lack of benefits of diversification. Investors and advisors are familiar with the concept that in managing a portfolio, whether it's an active portfolio or an index fund, more stocks, other things equal, are good. You get the benefit of diversification.
You diversify the risk.
It diversifies the risks of any individual holding. If I understood your argument properly, you're arguing that that is not the case as you assemble a portfolio of mutual funds.
Actively managed funds, it's a cumulative risk. It's not a reduction in risk. It's not only cumulative, but there's also an add-on. Every active manager you put in your portfolio increases the risk about 1.2 times. Mm-hmm. So there's no reduction of risk by having multiple active managers in a portfolio. It increases the risk of the portfolio. So the probability that portfolio will underperform all index funds goes up.
Am I oversimplifying if I say if the odds of one active manager are of outperforming are 1 in 3, then the odds of 2 outperforming are 1 in 9?
Not quite that high.
Okay.
It might be say,
even worse.
3 out of 10, and then when you add 3, it goes to 2
Right.
out of 5. I have the data in my book
Right.
of exactly what happens as you add more and more. Once you get up to 10 active managers, and you have them in your portfolio for 20 years, a 99% probability that portfolio will underperform a portfolio of index funds.
That was the same asset class as index
Same
funds.
asset class, the same percentages.
Right, exactly. Given the strength of the case for passive investing, why do so few people do it relative to the universe of both financial advisors and individuals? I mean, you kind of look at that. I mean,
it's a beautiful city. Beautiful city.
Me,
somebody has to pay for this city. It's like going to Vegas. Somebody has to pay for those lights.
Is there? I suppose one might argue that the urge to try to do better than average is so strong that it overcomes the statistics.
Yeah, in fact, Mir Statman just came out with a book, What Investors Want, and in the book, Mir talks about the utilitarian benefits of investing, which is simply to get to your financial objectives, which is what the power of passive investing is all about. But people also invest for emotional reasons, for social reasons. just the mention of the fact that you own a hedge fund says something.
Yes.
You don't even have to say what fund it is. It puts you in a different group of people.
I'm accredited.
Right, and you go to the club and you start talking about the stocks that you bought that outperformed. Of course, you never mention the ones that didn't outperform. But so there's much more to investing than just a utilitarian benefit of getting you where you need to go. I argue that, fine, take a little bit of money, bingo money, and go play the market. Most of your money should be in this type of portfolio.
Exactly. Your advisory business is obviously built around passive investing. I mean, to the advisors who are listening now, who might be thinking about shifting from their active strategies or incorporating passive vehicles into their strategies, what advice could you give them?
Well, a lot of people are doing that. A lot of advisors are shifting to index funds and ETFs. The problem is they're trying to do market timing and sector rotation, and that doesn't work. That actually reduces return. So if you're going to switch to indexing and passive investing, just do a buy, hold, and rebalance strategy.
Rick, I want to thank you for being here today.
Thank you, Craig. Appreciate it.
It's been great to have you. We've had the pleasure of talking to Rick Ferri, the author of The Power of Passive Investing, and we thank him again for being here. For those of you listening who have questions about our work at S&P Indices, particularly the SPIVA or persistence reports, you can find those at www.spindices.com. Thank you for listening.